Welcome, everyone. I'm Louis Lowe, and I'm really excited to welcome a fantastic group of panelists and quite a distinguished group of attendees on this call this morning. I was reviewing the list before we got started, and I saw about 250 friends, many old friends and some new friends, and welcome to our 8th webinar produced by my good friends Natasha, Vitaly, Brian, and myself at L2 Counsel. And before we get started, I think it'd be great if, Brian, you could start by introducing yourself. I'm going to do it for you. Brian has been a friend of mine for over 10 years. He started out in my world as the head of M&A legal at CBRE. Then he moved over to the dark side of corporate development and guiding the business terms of the term sheet. And now he's in private practice, and I have the privilege of working with him in that context. Brian?
Thanks, Lou. Yeah, actually, and even predating that, I spent a decade in major law firms in Palo Alto, Los Angeles, and Hong Kong. General corporate practice, but it's a significant weighting towards M&A and strategic transactions. So the segue into in-house, where we first met, and running M&A there globally, and then corporate development seems like has been a natural one. And it's good to be back now in this venue with you and sharing thoughts on M&A.
Thanks, Brian. Natasha?
Hi, everyone. Natasha Allen, founding partner of Allen and Hatcher. We are a corporate law firm with specialties in M&A and venture financing. So my background specifically started off in tax some years ago and transitioned to corporate and M&A work. So definitely in the wheelhouse of doing M&A transaction and strategic complex transactions as well. Thank you, Louis, for having us here today.
All right. And Vitaly, my partner in crime. 8th webinar.
Something like that.
He's an entrepreneur. He's a venture capitalist. He's an investment banker. Tell us about yourself. And a technologist.
Yeah, jack of all trades, master of none. So I've been on all sides of the table at this point. Most recently, last several years, I'm spending running an M&A boutique. And surprise, surprise, we focus on sell-side M&A primarily, sometimes buy-side, representing companies. As well as capital raises. And I specialize heavily in transportation mobility sector, but also do a lot in software, especially anything B2B or enterprise related.
Thanks, Vitaly, and thanks for joining. And I wanted to just quickly set the table for our discussion today. I think the first half of the year saw just a nosedive in the number and the volume of M&A transactions. As we kick off the second half of the year, I think last weekend, and really in my practice, I saw it pick up in the beginning of June, where just a number of parties started to really try and put deals together. And the genesis of today's webinar is just that experience. How has the M&A term sheet changed through the pandemic? And what are the best practices, and when do we use them, when do we not? And so we're going to dive into a lot of these questions today. We only are going to touch the slides for about 45 minutes, and then it would be the most fun if you all could use the Q&A function in Zoom and dive in with questions. And Vitaly is going to moderate and make sure that to the extent the questions are relevant exactly to the thing we're talking about at that time, we'll interrupt and deal with it. Otherwise, we'll hit them all in the last few minutes of the presentation. So thanks everyone for joining. And with that, let's dive right in, Vitaly. In your practice, do you favor a term sheet, or would you rather go straight to definitive docs?
I definitely like to start with a term sheet in any case, because it's a lot easier to negotiate a deal and some of the key points at that stage without diving into the documents. As much as I love all the lawyers in this world and on this call and in my household, it gets a lot more complicated when you're trying to negotiate every nuance without getting the key terms set first. So a term sheet is very helpful both with raising capital and a letter of intent, which is essentially a term sheet for M&A. Same thing. What's the purchase price? What are the kind of down term sheet terms and all the most important key points that everybody's happy with?
Yeah. How are you seeing the term sheet change in your practice, Natasha, since the outset of the pandemic?
So it's very interesting. So we've had a couple of transactions where people are really closely looking at every single term in a term sheet and trying to impose those as opposed to trying to negotiate a little bit outside of it. Also, some changes that you see are in terms of just diligence, right? So people are more focused on what is happening with regards to the force majeure clauses and is there an impact of COVID on the company and their ability to continue in this environment. So seeing a lot of different things kind of happening and the focus is changing in terms of what, buyers are looking at.
Thanks, Natasha. Brian, what changes are you seeing in the post-pandemic world in the term sheet? And are you seeing a term sheet at all, or are you seeing people dive right into definitive documents, or what's happening in the market?
Yeah, so actually, I want to go back just for a second to what Vitaly was saying, which is the benefit of the written term sheet in almost any context. The times that I've seen deals most likely to fall apart or become threatened is because either there wasn't a term sheet or the term sheet was just too high level and glossed over major issues, either major for the buyer or major for the seller. And if something is major, bring it up now. Make sure people understand how you get from the point of signing a term sheet to closing a deal. There's a lot of room to run between those points. So if something's important, talk about it then. In the context of the pandemic, I'm seeing basically smaller deals. And the leverage, at least from what I'm seeing, the leverage is on the buyer side. So they're imposing terms, and I think term sheets are also a little lighter, but as Natasha said, the diligence side of it has become important, and people are calling out very specific things on a diligence perspective, particularly with respect to MAC outs in terms of closing conditions and operating. How's the business operating? What's the revenue run rate? How has it changed?
So to sum it all up, we ought to have a very explicit term sheet, as explicit as we can, identify any deal breakers, bind exclusivity if that's what we're going to do, outline a timetable, and try and hold everything together with this term sheet. I would add, that I've seen in a couple of instances where a deal needs to happen very quickly, that people are skipping the term sheet and going right into the definitive documents as they don't want to get bogged down, and there just isn't time. So I agree with what everybody said about the advantages. And I just think in the world of the pandemic, some buyers are saying, here's our term sheet. You don't have to sign it. If you want us to move forward, we're going to just go right to definitive documents. And so,
Louis, maybe I can help on the segue here to give you kind of a counterpoint. Strategically, if you're the seller and you're overeager to just say yes, 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 buy us, you're really playing with your cards wide open. You do want to kind of hold back a little bit and understand what the core of the transaction is. So that maybe is a good segue to the disadvantages. From a buyer perspective, sure, if you can get somebody to agree in principle that they want to be acquired, and then you're going to grind them into dust in the nuance, then good for you. But it depends on what side you're on.
That's actually a really good point, and that goes back to the whole, where is the leverage in the transaction?
Yeah.
And leverage may have shifted given the environment we're in, and depending on which industry you're looking at. But if you are a seller and you don't have a lot of companies kind of jumping at you and really wanting to buy you, then you probably don't have a leverage right now. And if you go forward without a term sheet, woe be to you.
Right.
Yeah.
And I think that there's also a middle ground, right? So you can have lists of terms that are not necessarily signed in a particularly, extensive term sheet negotiation, kind of what Louis had alluded to before, but kind of having the high level, okay, what are we buying? How much are you buying it for? So just kind of laying out general terms so that people are on the same page. So you do have a starting point for the definitive agreement to be drafted.
That's a good point. The other item, there's a point on this list called costs. And sometimes sellers in particular think, they're trying to manage costs depending on the size of the transaction. And now I've got to negotiate a term sheet and then go and negotiate a purchase agreement as well. But I don't actually think you save money necessarily by avoiding a term sheet. I think you just, you recoup those costs, or you experience those costs on the backside when you get into the purchase agreement, the diligence stage.
Yeah, probably quite the contrary, right? It just takes that much longer to get definitive docs, and there's no guarantee they'll get done because the two parties might realize deep into it that they're very wide apart.
Yeah.
Yeah.
I guess to put a bow on it, in most circumstances, apart from when there just isn't time for a term sheet and it's the house is burning down or it's a bankruptcy situation, the buyer wants the term sheet in order to bind the seller on exclusivity. So the seller is going to have leverage up until the point that term sheet with exclusivity is signed. Once that is signed, there's just a giant shift in leverage over to the side of the buyer, and the buyer at that point will draft the definitive documents most of the time, and then they will be there will be no additional seller-friendly terms that aren't in the term sheet. So it's very important if you are a seller to try and get what you can get before you go exclusive. And that's a great segue to the next question is, what is a term sheet? Typically it's a non-binding instrument. There's a very rare circumstance where you make a term sheet fully binding in order to get a regulator to start reviewing it for antitrust law purposes. We've seen that in just a very, very limited set of circumstances. So for the most part, a term sheet's non-binding, and there are just specific provisions that might be binding. And there's a list here on the screen: exclusivity, confidentiality, sometimes fees and expenses, and diligence. Vitaly, are you seeing any change in during the pandemic as to what provisions of the term sheet are binding?
Yeah, I mean, I've seen here and there, I've seen some really odd propositions that companies have come to me for advice on, really kind of odd, binding or prepay, pay to, well, a company's asking, in one case, a potential buyer to prepay a deposit that's non-refundable to even do due diligence. I mean, some really odd things out there. And I think a lot of it is driven by, some of it is a little trickery, but other parts are kind of a little bit of fear in the water and fear of losing opportunities, in one case, or trying to snap something up quickly in another case.
Natasha, Brian, any changes that you've seen in the practice? I think what we've got on the screen are the typical list of binding provisions. Are you seeing any changes in the market?
Not really. I think generally sometimes governing law, sometimes you have non-solicit, non-compete, depending on what type of transaction you have. Those are some that maybe aren't on that list that are sometimes binding.
Well, that's a great question for the lawyers out there. New York or Delaware law for governing law in a term sheet? What do you prefer, Brian?
I always default to Delaware in general.
Same.
So there was a case in Delaware a couple of years ago where a seller tried to back out of a term sheet, and the court ruled that there was an implied duty of good faith to proceed on the basis of that term sheet. And I think there's been a move away from Delaware law as a result, that it could somehow be more binding than the parties intended, and there's been a move to New York law. But going back to the prior slide, Vitaly, if you don't mind, the one thing that I've seen change during this pandemic is on fees and expenses. I'm seeing buyers tell sellers that if they try and propose any term that's different in the definitive documents than what was agreed in the term sheet, that they will ask the seller to pay their fees and expenses. And that is really an intentional hammer to say to the sellers, hey, listen, we've got you, and don't try and renegotiate this deal. It needs to go fast, and we can't waste expenses renegotiating things that were already agreed. So that's the one thing that I'm seeing in the market right now, with being as buyer friendly as it is. I'm not seeing entire term sheets going binding just yet, although I think that we may see that in more desperate circumstances as the year goes on.
Just Louis, just to throw something out there. It's not so much a change, but kind of a response, which is, and this is for the sellers out there, and this goes back to the whole leverage conversation, which is, it doesn't matter when you're doing it, but keep in mind that the buyer may be imposing that condition that Louis just described, but they will not feel reticent to throw in new conditions and new terms in the transaction when you get to the purchase stage. So I would say, depending on the leverage, if you are not completely at risk, try and fight provisions like that where you don't have the ability to continue negotiating as you go along, because the truth is a transaction is a living thing. It morphs, it adjusts, and the more the sides learn about each other as they go along, the more things just kind of pop up out of the woodwork. And that also goes to exclusivity on the sell side. You are locked in at that point, so keep it short. Make the buyer come back to you every 30 days if you can. Hard to do 30 days, but the buyer's going to want 90 days or more. Make them come back, make them keep asking for it, because every time they do, then there's a conversation about, well, how's the progress on this transaction? Is the buyer going fast enough? You can use these things if you can make sure that the term sheet has the right provisions going forward.
Another thing to be careful of for exclusivity was I had a situation where the exclusivity period just extended automatically. So if you hit an end, it would just continue for another period of time. So just being careful of that, because it can go on and on forever with no end in sight. So that's another thing you have to be careful when you're looking at exclusivity provisions, is just to see when is the end date and is there some type of evergreen language that it'll never end.
Yeah, there's one question we've got in the Q&A about whether we're seeing breakup fees added to the term sheet, and I do think that that's something that people are proposing right now are break fees. Buyers are saying, hey, if I'm going to go to the trouble and expense of going exclusive and diving into this, and if you do an alternative deal after the end, I want to get paid. I wouldn't mean to say that it's become the norm at all. Just I've seen buyers just try a lot of tricks to bind sellers in these times.
Yeah, I would add something. I'm suspecting a lot of folks that we have watching along right now have never actually seen a term sheet. And I think it's important to understand kind of the general wording on term sheets, both on investment and M&A, is that you have a number of provisions that are non-binding, and then you have very specific binding provisions. Usually the exclusivity, that's probably almost always the one that's called out and said everything's non-binding except exclusivity, that you can't talk to anybody else about this transaction, you can't shop this transaction. And that's essentially the buyer making sure that their term sheet's not being used to go shop around all over town to get a better deal. That's an important factor. And as far as the breakup fees, I think if you do a quick search and you look at the news right now, there are a lot of deals that went into discussions or post-term sheet before the pandemic. And then there are a lot of buyers that got cold feet, especially when we're talking about like retail, buying big retailers. And a lot of people are trying to walk away from those transactions because all of a sudden, I think Victoria's Secret is one of them. That deal is all of a sudden worth a whole lot less or nothing. And the private equity buyers are trying to walk away from those transactions for obvious reasons. And there's going to be an interesting fight about that. And then the breakup fees can be pretty substantial depending on the size of the transaction.
Yeah, I was reading that some of the studies that they've done in terms of M&A transactions over the past 4 or 5 years, breakup fees can be anywhere from about 5.5% of the total deal value. So that can be extensive depending on how much the total consideration is for the transactions.
And for the seller, the breakup fee also is no panacea. It might cover your costs, but it definitely slows down your process, and it's a huge opportunity cost. So if you had 2 potential buyers that you're choosing from, and then you chose one and the transaction didn't come through, it's very unlikely you're going to get the other one back to the table, or you're going to take a huge haircut, when they know that they're the only game in town.
Great point. We've got a question from Rick Andrade on the Q&A function about how due diligence has changed in the term sheet. And I think that's a fair point, that if there are specific issues that you spell those out, whether it's that at a certain point you want to be able to talk to a certain number of customers, or a certain customer in particular, or a channel partner. I'm definitely seeing that people are getting kind of specific about what diligence requirements that they have. And I will note that in the pandemic, one of the diligence points that is hard to do is just to walk the land and meet people face to face. And so, you know, I've seen one transaction where the buyer spelled out that there would have to be a face-to-face meeting at some point before signing as a condition to their proceeding with the deal. And you know, that's really a sign of the times that we're now in a point where transactions are happening between parties where the discussion commenced post lockdown, and where a face-to-face meeting has not occurred, and that's kind of a stunning development in the world, and I think we're going to start to see a lot more of those as time goes on. I would also note that for cross-border deals, those face-to-face meetings are especially difficult, where there are not only intra-state lockdowns, but there are border controls that stop travel.
All right, should we jump to the next point? Make sure we don't fall behind.
Yeah, please.
Unintentional binding obligations.
Yeah, on this one, I think we want to make sure that people are disclaiming any duty to negotiate in good faith. I think that's very important to make sure that both parties can get out of a deal if they want to, so that's the point of that one. Natasha, Brian, you want to talk about partial performance or remedies for breach? Is that something that you're seeing? I think that goes to the break fee point. Maybe we can skip to the next slide if no one has anything to add.
Just that for partial performance, you just want to be careful that you can have, the courts have decided that some term sheets have been legally binding just by fact of individuals moving forward with doing actions that indicate that. So for example, there was a case, Bed and Beyond, where the seller company had started construction, even though the term sheet was not binding. But the court had found that it was a binding agreement and they had to move forward. So if you're moving, so you want to be careful in terms of what actions you're taking, which can result in a term sheet being considered by a court as being actually binding. Gotcha.
There's a quick question that I think some more people might be curious about is, how does the breakup fee actually work? I don't think we explained that. Louis, maybe you can take that one.
Sure. So the break fee can work in a number of ways. If the seller walks away from the deal, that's what we call the traditional break fee, and does an alternative transaction within some period of time after breaking the deal. Then some portion of the transaction proceeds that the seller receives have to be given to the buyer, and those typically are somewhere in a range of 4 to 6%. I've seen those a lot in life science deals, where you know, there's essentially a competitive auction for a molecule that has received some sort of an FDA approval or is in the final stages of obtaining an FDA approval, and there's concern that after the FDA approval is received, that the seller will walk and do a deal with somebody else. So that's the traditional break fee. Then there's what's called a reverse break fee, where which happens in the definitive document, and it says that if the buyer fails to get financing or the buyer walks away from the deal for whatever reason, they have to pay some portion of the proceeds to the seller. And so essentially that says that a transaction shouldn't be just a free option for a buyer, and that if they walk from a deal and take a seller off the market for some period of time and then don't fail to close, that they pay a reverse break fee. And typically, if it's a straight walk away right, it's going to be a higher number. And if it's the failure of a condition to be satisfied, such as failure to obtain financing, then you know, the buyers will pay a lower reverse break fee, somewhere in the 2% range. So that's forward and reverse break fees in a nutshell, Vitaly.
Thanks, sir. There's another, quick question. Maybe I can cover that. You know, if the term sheet is mostly non-binding, why is it such a useful tool? I mean, ultimately, it's just to make sure that the two parties are on the same page. Before you really spend more time, you dive in, and then you find out in the nuance that you're far, far apart. That's probably 80% of the effort, is to make sure that everybody is kind of agreed in principle, to then move on to the details and due diligence.
Great point. Great point. Shall we hit the next slide? Content. So we wanted to lay out here what are kind of the key components of the term sheet. Who's going to be a party to it. So not only is there a buyer or a seller, but sometimes there's going to be stockholders that are signing up, founders, key employees. It really runs the gamut. And next is structure. How is that going to be? How is this transaction going to be accomplished? And sometimes at the term sheet stage, you don't know, and it's not specified. You just say you're acquiring the business. But an acquisition of a business can happen in a multitude of ways. It can happen by an asset purchase, where the buyer looks at everything that the seller owns and just picks and chooses which assets it wants to take and leaves behind not only entity, but perhaps what it views as patent or latent liabilities. The asset acquisition is really negative for a seller, not only because they're going to be left behind with an entity to wind down and assets that the buyer doesn't want and liabilities that are perhaps unquantifiable, but the tax treatment to a seller of an asset deal, particularly a corporate seller, can be fairly punitive, as the seller is going to have to recognize tax not only at the corporate level, but then when it distributes the proceeds out to the owners of the business, the owners are then going to pay a separate level of tax if it's not an LLC. So the asset structure is not really ideal from a seller perspective, but sometimes it's the best deal that's available. In a bankruptcy situation, it is definitely the deal that is on the table. A license is a very creative way of structuring an acquisition where the parties can't agree, or you've got to move very quickly, and the seller has intellectual property and can simply convey that to the rights to use it to a buyer through a license. Then there's a share purchase where the buyer acquires the entire entity by acquiring every single share or a majority share, and thereby acquires control. The downside of a share purchase for a seller is that it requires everybody to agree and running around and getting signatures. And as a result, it's oftentimes preferable for sellers to go for a merger where they know that the entire entity can be conveyed to a buyer simply by a majority vote or a supermajority vote of one or multiple classes of shares. So a merger is really the quickest and easiest way of doing a merger to convey an entity. So that's structure. Next is purchase price. You want to be really clear if you're a seller that you're not going to be subject to a holdback or an escrow in an amount larger than is agreed. So that's a key term to negotiate in the term sheet. And with the advent of rep and warranty insurance and externalizing the security for breaches of reps and warranties, we're seeing that holdbacks and escrows are really dropping dramatically. And the typical holdback and escrow in a rep and warranty deal is just 1%. So the buyer will hold back 1% of the purchase price, which will be in jeopardy if there's a breach of rep and warranty, and so there's skin in the game, and then anything above that up to a cap is assumed by the insurance company, subject to whatever exclusion. So those are the holdbacks and escrows. And then finally, earnouts. And since I've talked too much, Brian, you're an expert in earnouts. I think you have mastered, I don't know how many dozens of those in all the acquisitions that you've done. And what are the key terms in laying out an earnout? And are you seeing more or less earnouts in the world post-pandemic?
Yeah, earnouts are challenging. So an earnout, for people who aren't familiar, an earnout is basically where you say some portion of the purchase price, we really can't agree on it now, where we're at in terms of what's the total value to be delivered. And what we, the buyer, want to see is some form of performance over time to allow you, the seller, to reach a certain level of purchase price. And so this is a way for a buyer to get more comfort in terms of delivering 100% of the purchase price, that they're really getting what they paid for. And sometimes it's a way for a seller to get more money than they might have gotten at closing just based on a cash deal up front. So the trick for an earnout is getting people to agree on how you measure performance and how the sellers will have enough control after closing to make sure that they're comfortable that they can deliver performance. And that is usually 95% of the argument around an earnout is going to be in the operating covenants post-closing. The purchase agreement has to have some language that says, here's what you, the sellers, and the employees have to do to get the additional purchase price. And the sellers have to know that they have enough operating control to deliver. And the problem with most companies is there's a lot of rules to managing a company, and you have accounting rules and legal rules, and you have management. And if you're a public company, you have public disclosures. So you can't just have employees out there kind of making their own decisions at every turn with their goal of always delivering 100% financial performance on their own operating conditions post-closing, or their earnout that may actually be in conflict with how the company is run or what the company has to deliver in the public markets, for example. So earnouts are a struggle. Earnouts, keep in mind, don't always have to be based on financial performance. And this is where I've seen a lot of interesting and creative earnouts, particularly in my old days at CBRE, which, you know, what we did was we went out and bought companies that were all about people. And so what you're really trying to make sure is, are the people going to be there for some period of time? So you can come up with interesting and creative formulas that where the earnout is really built around the performance of groups of people within that seller group over time, and gives you comfort that financial performance is there, but also that people are still there without actually hurting how the accounting or how the transaction is accounted for.
If I can add a little bit on mechanics, sorry, on that, you know, there's two ways to look at it. Yes, one thing is to retain a team, especially if you're looking at acqui-hires. That's the whole point. And there needs to be a set of incentives put in place long-term to keep those people happy and engaged in the company for the, you know, at least several years to come. The other part of it that I've seen in some cases is tying a big chunk of the purchase price as an earnout tied to sales performance. So if you go in to a deal and you're an overly optimistic startup and you're saying, well, here's our vector, here's how much we're gonna, you know, 10x next year in our sales, then I say, great, show me 10x and I'll pay you the full price. You've kind of trapped yourself. So you want to be a little bit modest in your projections and make sure you're going to hit those, and make sure you have the resources from the buyer, you know, marketing budget or what have you, to be able to get there, or customer acquisition to be more specific. The other part of it is that when you're a seller and you're negotiating that earnout based on sales performance, you also want to have some variability. So if you outperform your plan, you get a little bit of a bonus on top, right? It's not that you're just shooting to get what you in your mind already gotten out of the deal and you have to hit those numbers. But if you outperform, there's some motivation and your buyer will be happy to pay that anyway.
Great point. Natasha, I want to bring you into this. In your experience, who typically pays for rep and warranty insurance? Is it buyer or seller, or does it just come out of the deal price, which essentially means it's the seller?
We had a talk on this before, and I think the insurance person had said that typically it's the buyer. Sometimes it's split between buyer and seller. And in our current transaction, it's going to, in a couple of transactions that I've worked on, it was the buyer who paid for the rep and warranty insurance. Yeah,
I think that's right. I think it's really the buyer that's contracting, but and is the counterparty with the insurance provider. But the dollars are coming out of the enterprise value of the company, and so essentially that means the seller is paying. Although, you know, we do see a lot of situations where sellers come in and in the background want to insure a specific risk without even telling the buyer, or maybe they do. And sometimes the buyer is going to come in and buy a specific policy against a specific risk. But of course, as Patrick Stroth from Rubicon reminded us last week, you know, known risks or known liabilities are not typically insurable. Those are usually excluded. Another question for you, Natasha, you know, what are you seeing in terms of just typical holdbacks and escrows in the post-COVID environment? Are you seeing a radical shift away from kind of the 10 to 20% bogey, or are you seeing it shift towards the 20% end, or are you seeing it sub 10 single digits?
I'd say not definitely going single digits. I think it's staying within the 10 to sometimes 20%. It just depends on, obviously, after diligence and you see what exposures are out there. But seeing more push towards holdbacks as opposed to escrow. So holdbacks are where the companies actually keep the funds as opposed to using a third party. Obviously, for a seller, you prefer a third party holding the cash as opposed to the buyer, and as a buyer, you prefer to hold the cash, time value of money, so you can invest it while you're waiting for a period of time. But that's typically what I've been seeing.
Yeah, I mean, for buyers and sellers out there, I think insurance is the way to go, almost all of the time. Really, the only reason not to go with insurance if you're a buyer is to really, as to Brian's point, hold the seller's feet to the fire, that they stick around to make sure that they themselves are mitigating risks and making sure that the business is performing. But in just about every other circumstance, it's just infinitely better to outsource that risk to a third party. Acquisitions, especially in technology, are of intellectual property and people. And so the people are typically the sellers. They've become your employees. And so making a claim against your own employees is, the worst thing you ever want to do, and the worst way to incentivize them. So if you can externalize that to a third party, that's always easiest. And whereas it used to be that transactions below 150 million were not insurable, we've now seen that insurance is available in the lower middle market, and that's really been the great advent of this year. There's another great question about how earnouts have changed in a post-COVID world, and whether or not the earnout can get you back to your pre-COVID valuation. And I would say the answer to that is totally not. I'm seeing that buyers are demanding a very significant cut to pre-COVID valuation as a condition in discussing a transaction. I've seen transactions where there was a pre-COVID term sheet, and the sellers came back post-COVID and renegotiated the price, and I think that's been pretty standard. And I don't think an earnout gets you back to a pre-COVID price. That begs the question, why? And I think the why is that there really is just a view that growth is not going to be large enough to justify the pre-COVID valuation that was out there, and no seller just even wants to be in the same universe as that pre-COVID valuation. That's my 2 cents to your great questions, Rick and others.
Hey, Louis, just a time check for you. We're on slide 3, and we've got 5 more to go, so we should probably pick up the pace.
Did we cover everything here? Closing conditions and key dates, I think that's important.
Brian, you want to take that?
Yeah, so closing conditions in a term sheet. This is the opportunity for both sides, particularly the buyer, to say, okay, here's what we expect to be in place for us to actually get through all this work, sign up the deal documents, and close a deal. And that depends on whether, again, you have a transaction that you're anticipating will be a simultaneous sign and close, or one where you sign and close later. Because if you sign and close later, your purchase agreement will now have a whole raft of closing conditions. But let's just keep it simple at the term sheet. It could be that there's something as simple as, but controversial as, a no material adverse effect, or a MAC out. So that can be particularly problematic during times like this, COVID-19, right? So it may be that we have to have access to certain types of information or customers, technology. We want to test the product, so this could all be part of the diligence process, but you might close these out in closing conditions. It could be that X% of the employees have to be in place, and this will kind of make its way into the purchase agreement as well. So it's basically anything that's really critical to the buyer, which includes deal approvals. The shareholders have approved, the company's approved, and sometimes it's what level of approval. So think about it from a broad shareholder base where you've got a few hundred shareholders, and the seller wants to make, or the buyer wants to make sure that X percent are going to be on board with the transaction, because most of those are either employees or have some sort of strategic relationship in the company. So again, it's just the opportunity to say what's important to move this forward. Again, from the seller side as well, but for the seller side, it's typically a little more straightforward. You have to deliver money at closing. The deal has to, conclude, and the sellers have to get paid.
Great point. Natasha, any other changes to the content of the term sheet you want to call out in the world of COVID, or tips to share before we hit the next slide?
I would say key dates, you just want to know maybe when the proposed closing is and when the diligence period should end, so that you're not having the buyer do diligence forever. Another thing is maybe just a termination for the term sheet itself. So is it at the time of a definitive agreement? Is it mutual agreement? Is it after a certain time period, so that you know when this actual term sheet ends?
Great point. Great point. You want to hit the next slide, Vitaly?
All right. There was some tax treatment and fee expenses, confidentiality, those kind of things. We kind of hit most of those, yeah?
I think we did.
All right, let's keep moving.
Purchase price, cash, stock, other consideration. How's that valued? When is it valued? Obviously, there was a big stock deal announced this week with Analog Devices buying Maxim in a stock deal. And what's always interesting in those is what's the value of the stock? How's it valued, and when? And is there a collar around it? Is there a minimum or a maximum? Those are always exciting terms to address. Brian, how do you value non-cash consideration?
Depends what the non-cash consideration is, doesn't it?
Yeah, exactly.
So, if there is real estate involved in the transaction, you basically have to either get appraisals. So you might have third-party appraisals. You might have market comps. So I'm, again, thinking about it in the sense of real physical assets. What are the comps? How do you get to evaluation quickly? Is there time between the term sheet and closing to go out and get a third-party valuation, and then adjust how much of the purchase price is being allocated to that asset? So it's I don't think there's a hard and fast rule, because it really just depends on what is the asset that's being thrown in. It's not cash.
Great point. And Vitaly, are you seeing a lot more assumptions being introduced by buyers into the term sheet about what seller's revenue was, or pipeline, or any other conditions?
Yeah, I mean, there's a certain belief level, right? You want to, by default, you want to believe what's being presented to you, but you certainly want to audit those numbers. There are some bad characters, but there are also some mistakes out there. I was going to add, I mean, this is kind of the purchase price and structuring this deal is a very complicated topic all on its own. That there are investment banking textbooks about this and how to structure this. But keep in mind that if it's a public company buying a private company, and it's a big enough transaction to really kind of move the needle, and it's done in stock, a lot of times you'll see kind of this interesting phenomenon that as soon as that transaction gets announced, the buyer's stock price goes up, 4 times the value of that transaction. That the market really puts a lot of stock into that strategy and kind of reads it a lot into it. So one area that I'll hint on that we certainly don't have time to cover in depth is if you are structuring a stock deal, you want to really think about and get good guidance on how material will this transaction be to the buyer and what that will do to that stock price. So are you getting stock the day before the transaction, based on that value, the day of the transaction when it gets announced, the average of the next 30 days after that? There's a lot of consideration that goes into how you structure a stock deal. There's a lot of complexity besides just a headline number.
I'm just going to tell a quick war story. Back in the last, the Great Recession, it's 2009. We're representing a public company. It's just gotten its clock cleaned in patent litigation, and its stock price goes from 15 bucks to $1. We sold at $1.09, thinking that you know, we might not make it any further, but we did it in an all-cash deal. 6 months later, pardon me, in an all-stock deal. 6 months later, that stock was worth $5 and something, so 5 times the amount. And of course, the selling stockholders were able to ride the recovery and drive huge returns by accepting stock instead of cash. So I believe that as the year goes on, we're going to see more of these stock deals where you know, the sellers can retain some of the future upside of the combined company. And finally, I think it's absolutely the case that we're seeing assumptions dropped into term sheets about how the purchase price is derived and how it could change if those assumptions changed. Shall we hit the next slide? Vitaly, you know, what are you seeing buyers doing to protect the purchase price? And Brian and Natasha, how are you seeing sellers respond? If you want to start, Vitaly.
Well, I mean, buyers want to be confident in what they're buying, and you know, they're going to be a little bit skeptical. Just like, you know, I'll give you an example. If you're buying a house, you're going to want to do some inspections, right? So you're going to put down your deposit. You're going to assume everything's great, but then you're going to send your inspectors in there to look at the cracked foundation and this and that, and find the, you know, the problems in this asset that you're getting. And you have to assume there are going to be some problems always, unless it's like a really super early stage company that, you know, everything you can analyze the entire company in 2 hours. So, you know, you're going to want some protections in there, and you're going to want some assurances, and you're going to want some firm language if you're the buyer, to basically say, if this and this actually checks out, then everything's great. Otherwise, there will be adjustments, kind of net. So I would say generally that's probably the approach I would take.
Yeah, so I've been seeing private equity buyers for years throw in auditors into the sellers to produce for the buyers what's called a quality of earnings report, and it's essentially an attempt to discredit the seller's numbers. And I've seen some sellers anticipate that by delivering to the buyers a quality of earnings report that they've already commissioned from a third party that is at least fair in the minds of the sellers. And so that's one way I'm seeing buyers kind of attack the assumptions once the diligence process begins. Brian, talk to me about closing and post-closing adjustments, and do you spell that out in the term sheet, or is that something you wait for the definitive?
Yeah, I'm kind of used to seeing the post-closing adjustments more in the definitive, unless there's really an obvious large issue that people know to address now in the term sheet. Mm-hmm. So whether it's a working capital adjustment, we used to kind of have these standard in the real estate space, because you're dealing with lots of small companies that their financials are often very questionable, just in terms of the quality of the financials. So we almost always had to go back and rebuild the financials for them, and kind of look at working capital and often educate them. And I think that can be the case just depending on the size of the transaction and the counterparty if you're on the buy side. But being able to kind of work through something like the financials, more of a definitive document stage, kind of, because then you start really spelling out how do you get to working capital. Earnouts, usually I see those brought up in the term sheet. If there's going to be an earnout, that's where it's at. Allocations of basis, most of the time I see that in definitive documents. And the allocation of basis, it's usually the issue can be around timing. When do you deliver that? Seller wants it sooner, buyer wants to take their time, most often. Claims for indemnification, kind of the high level points, usually in the term sheet, in the sense of what are the big issues and how do you treat it? And those tie into kind of what's the escrow, what's the holdback, quite often, particularly the escrow, and the same with set-offs.
Natasha, any changes to all this in the post-pandemic world that you wanted to call out?
I would say definitely I see a lot of the buyers pushing to have some type of holdback. I think prior you could kind of get away with not having holdbacks or escrows, but there has been a push for some monies to be allocated. And again, like you said, rep and warranty insurance could cover that off, but in some of the transactions I've been seeing in terms of just making sure that the buyer is feeling more comfortable in terms of the state of what they're acquiring, they do want money held back.
That is a great point, Natasha. For those deals where there's no rep and warranty, buyers identifying risks and doing special holdbacks is definitely something that I'm hearing about buyers trying to do, and thanks for calling that out. Shall we hit the next slide, Vitaly? I'm also noticing the awesome questions that are piling up in the Q&A.
Yeah, we're gonna have to cover those at some point. Yeah, I mean, one thing that I'll just kind of dumb it down as well. It's, the holdbacks are essentially a form of insurance, essentially, right? And where before everybody was calm and the environment was, what's the worst that can happen? Now we know what's the worst that can happen. There's a lot of uncertainty, and therefore you're going to see a lot more of these kind of protective provisions coming into play.
I hope you're right that we know that what the worst is.
We don't. So those provisions are going to be 110% of the purchase price.
Yeah, in Santa Clara County, which is where the home of Palo Alto and Silicon Valley, we did not have hair salons or barbershops open. So yesterday they opened at the same time as the governor announced that the following day they would be shut. So you never know.
Really bad day for me, So, all right.
It's of the Vitaly cut. I think we've covered deal structures. In the interest of time,
Forward. Yep.
I think we've also handled earnouts for the most part. But maybe, Brian, you've got a world of experience helping parties. I won't say resolve the dispute, but rather come to agreement on an earnout. And I'd love for you to share your advice on that for folks.
Sure. So I think the important thing to think about with earnouts is when you have a transaction where you've basically brought in the sellers, they're now your employees. From a management, buyer side perspective, every decision you make around the earnout has the impact to threaten the dollars that the sellers, now your employees, think are coming to them. So when there's a dispute around the earnout, quite often the dispute is around the performance level. Was it satisfied, and why wasn't it satisfied? Because the one question automatically on the seller side leads to the other question. Yes, we didn't hit those numbers, but here's why. You didn't let us do X, Y, and Z. We were supposed to have marketing control. We were supposed to be able to go out and sign contracts up to X dollars without 7 layers of approval. So the trick there, I think, for solving disputes around earnouts is kind of finding that balance where you can educate the other side. And often that means the buyer trying to educate the seller, the selling employees, as to why they didn't hit those thresholds and why they were reasonable in limiting basically operating control for the sellers who are now your employees. But doing it in a way that doesn't come across as too punitive, because just think about it this way. You are trying to incent and motivate your employees every day. In the Silicon Valley, that in many places, that is the primary value of your company. It's the people that deliver services or build products every day. So you've got to find a balance. It can't just be, or it usually can't just be a dollar discussion. It is how do we protect the rights of the company? How do we protect the bottom line, the balance sheet, while also not leaving employees feeling like they just got burned?
Yeah, what I thought you were always so great at, Brian, in your days running the M&A function is I think you convinced sellers that you really wanted to pay the earnout, and you, as time wore on, you adjusted the conditions so that there was still an incentive and a carrot, even if circumstances changed. And I think that's the hallmark of of a good business relationship. Natasha, how do you resolve disputes if you don't have Brian involved, making sure people get to the right business answer and guns are out? You know, who's the right person to resolve that dispute? Is it a court? Is it arbitration? Is it an independent financial accounting firm? You know, what's your experience and what do you think works best?
I think there's probably levels, right? So I don't think you go straight to the courts. You probably want to see if there's some way that you can have maybe a financial institution to start off. If that doesn't work, then maybe go to arbitration. But I don't think the first thing is to go guns blazing and start litigation right away.
Right.
That's one way to quickly ruin a relationship.
Yeah. I think if you're going to have an earnout, you've got to have a really
Exactly.
precise mechanism to resolve disputes that's time bound and you know has clear procedures that you know don't involve you know court and discovery and all of that sort of stuff, because you know at that point to Vitaly's point, the business has exploded. Moving into special issues, there are so many things that we could have covered on this call, and you know in the next two slides we're just going to hit a few you know really special issues that happen particularly when companies are getting sold in a fire sale or quickly because of circumstances. And you know the first one is obviously how do you incentivize the employees that are needed to monetize the intellectual property, the technology that you're acquiring for the business. And so, you know, you've got to either do that in a carve-out plan where the sellers are having to incentivize the employees who are otherwise out of the money to get a piece of the sale price, or if you're if there isn't any money for that, you're the buyer, you want to incentivize your team. What do you do? And so Brian, Natasha, Vitaly, you know, throwing it out there, what things are you seeing right now to you know keep employees motivated to monetize technology and businesses?
I would say on the one hand, it hasn't changed. On the other hand, it probably has. On the one hand, you know, when you're dealing with a situation where the founders have been diluted to like single digits, which happens more often than you think, the management carve-out is designed to incentivize them and give them bigger part of the economics of the transaction, so they stick around, especially kind of with the earnout, that they have an opportunity to make some money, some serious money that they think is worth their time. And the way to do that is to really engineer their employment agreement, where a lot of the economics come into that. So there's a little bit of conflict that comes up where the investors all of a sudden want to understand what's in that employment agreement and what's being swung to the side of the deal that they don't get. They don't get economics out of as investors. So that's usually a friction point that comes up that you have to be very careful with. And then treatment of options, contribution acceleration, all these things. I mean, you essentially accelerate everybody that's been active, and you want to do the right thing there and make sure that everybody gets part of the economics. I think I'd leave it at that level of detail on my side.
Brian, Natasha, anything to add on management carve-outs and whether that's seller's problem, buyer's problem, and what you're seeing in terms of acceleration or equity roles at this point?
So the equity rules, some of the equity rules you've set aside an incentive pool also for the other employees that are not the founders or the key employees, but individuals that you want to stay for a little bit longer. So making sure that something is set aside for them to incentivize them to continue to work on. So a lot of the things dealing with, you know, management carve-outs, that's focusing more on the founders, but the other key employees that you want to have around for some time, you want to make sure that you're also incentivizing their needs. And that can be done by putting aside stock for them or some type of restricted stock in the new company or wherever they're going.
Yeah, I've seen that in the last 10 years, some just very interesting and highly structured ways to incentivize employees. And I've seen sellers sharing the wealth and doing that as part of the sale proceeds. And I've seen buyers do that as part of a new equity program or cash bonus plan. And I think it's a great tool that lawyers should introduce to help parties bridge the gap. And it's exciting to be involved in transactions where people are far apart, because, you know, we as lawyers have the opportunity to really add value and bring people together. And I think, Vitaly, you do a great job top of that as well in your role as a banker. I know we have just a lot of questions in the backlog, and we're just past the top of the hour. And so, Vitaly, I wonder if you wanted to, take us through those, or whether we should hit some more tips and tricks here.
I think we probably covered a lot through the conversation here, and some things we should take offline. I would say that for those folks that are jumping off because it's top of the hour, is here's our contact information, and you should definitely reach out. I think the biggest takeaway I would say for all of this is make sure you have the right counsel around you. Certainly, there are a lot of things that you should understand if you're a founder looking at selling your company. But understand that it's likely you're doing it for the first time. If you're on this webcast, very likely. And the folks that you're dealing with on the other side of the table, it's their job. They are corp dev. It's their full-time job. It's their full-time career. It's like playing, a 5-year-old playing chess against a grandmaster. So you need proper, advisors around you to help you structure a deal that's not going to blow up in your face. Very often founders are, they have all their eggs in one basket. They're overweight in their personal portfolio into one private company that they've been working on for many years. And this is a lot of risk for you to take on. If you're an investor and you have a portfolio of companies, you understand that most of them are not going to do well, but some of them are going to do great. As a founder, you don't really have that choice. I've been on that side for 16 years with three different companies of my own, and I can tell you what the risks are. So that would be my takeaway, is make sure that you have good counsel around you. You have people that know what they're doing and have the experience, that are your advocates in the transaction, bankers, lawyers, etc. So with that, maybe we cover some more Q&A for those that are sticking around.
Vitaly, thank you for that. I just wanted to add one point on selecting a banker, as I had a conversation with a founder just yesterday about that. And I always recommend to founders that they pick somebody that they're comfortable with, and whether in any advising relationship. But in terms of banker especially, you want to be looking for somebody who knows your space, who knows the players in the ecosystem, and who is going to hustle on your behalf. The worst thing I see is oftentimes advisors get signed up and they lose their enthusiasm, and they don't really work so hard to drive for a transaction, and so you don't get fully marketed and the best possible price. And so that's my recommendation always when selecting advisors, is people that you connect with and that are really going to hustle for you. Vitaly, let's hit the Q&A.
And Judge, Louis, just to throw in on that, and it's not just to get you to signing a term sheet. The best bankers, they hold your hand to the end. They're there with you. Vitaly is the kind of guy that earns his keep.
Yeah, you got to manage the lawyers. Somebody's got to manage the lawyers. So,
someone's
all right. So let's see. So first of all, one important question for everybody. Yes, I think the slides will be available. The recording will be available. So that's important. And I think something we didn't cover is board finesse, right? So the first question is, please discuss how boards finesse their fiduciary duty to the shareholders while considering exclusivity. But I think if we kind of broaden that question on kind of what's the board's role in all of this, and how does this work, who drives the process, and what approvals have to be done at the board level? Well, in acquisition, this is the ultimate transaction for the company. So Louis, maybe you want to take that direction?
Sure. I'll start off by saying directors have a fiduciary duty when a company is for sale to get the best possible price for all holders, which means that it's not just for the preferred directors, but also for the common. And there's often the circumstance where, especially in today's distressed times, where the preferred stack of liquidation preference is larger than the sale price of the company, and there's nothing left over for the common. And so how can the board do their fiduciary duty for all holders if they're going to get zero for the common? And typically, a way to do that is to have a management carve-out plan to incentivize management to bring a company all the way across the finish line to closing, number one, and two, to reserve another portion of the purchase price for non-management common stockholders. And it doesn't have to be a huge amount, but that's one way I see board members finesse that obligation. I would back up a step and say, if you're not for sale, you have no duty to listen to any offers to sell your company or negotiate with anyone. But once you do declare that you're for sale and you engage an investment banker and you've got a process going, you do have a duty. And as to how do you know when it's okay to go exclusive, there I think it's your banker's advice that they've done a market check, they've talked to the ecosystem players, and they believe that it's the best price that they're going to be able to find, number one. And then number two, it's looking at the financial analysis that they provide to you, that the value, that the price being paid is worth more than the discounted cash flows, it's worth more than comparable transactions, and it's worth more than the trading price of companies in the market. And so those are kind of the traditional metrics of enterprise value that people like Vitaly can demonstrate as your financial advisor and help you know that you've complied with your fiduciary duties. Two more things. You should have an indemnification agreement from your company. And when I join as an advisor to a company, the first thing I do is make sure that my directors and officers have indemnification agreements and that the charter and bylaws specify that so that they're not in harm's way. And two is I make sure that there's an insurance policy to back that up. And that's a special insurance policy for directors and officers liability. It's affordable, and it's something that you absolutely should have in place if you're a director or an officer of even a private company. And even as soon as they raise their first round of financing, that really should be in place.
Very good point. So Brian, unless you have something to add, maybe we'll hit the next one. I think it's good to cover. There's several questions that are poking around kind of the structure, and when you're buying a license without the assets and liabilities, maybe I can kind of kick that off a little bit and see what you guys want to add. And we lost Natasha at the top of the hour there. So when there are a few different ways to do this. If you are a buyer and really what you're after is a couple of assets in the company, you don't really need the team, you don't really need the brand, and you just want access to the tech, then it's going to behoove you to try to just do a license deal or just to do an asset purchase. Of course, for the seller, it's like you've built your aftermarket car with all these bells and whistles, and then somebody just wants to come and get the tires. You're pretty much done, at that point. But in a lot of cases, let's face it, in this type of environment, for a lot of startups, that's their kind of landing on the roof. That's some way for them to return some capital, for the founders to get some economics and maybe get an attractive job offer from the acquirer for a while they recoup and plan their next battle, their next startup. And they can return some capital to their investors, and that's always a nice thing to do if you want to keep the relationship. One thing too, as I'll mention, is in most cases, probably 99% of the time, unless you're like, this is your last startup and you're going to retire, you want to keep relationships with everybody that's been helpful along the way, and you want to do the right thing. So even if you are, as a founder, personally suffering and you're not getting the exit out of it that you hoped and wished for, you want to do right by your investors first and foremost. So I'll kind of kick it off in that direction.
I was going to go hit another question unless you wanted to add to that, Brian.
No, I think that was.
There was a really good question from Tim Bin about working capital adjustments and transactions and whether they're standard or not. I think that the level playing field in a transaction is that the purchase price is based on a cash-free and debt-free seller, but with a normal amount of working capital inside the company, such that buyer doesn't have to infuse more than the purchase price into the company in order to operate it. And that's typically, rule of thumbs, lick my finger and stick it in the air, is 2 months of operating expenses, but it could be more, it could be less, and that's typically how I see that one resolved. Brian, do you want to add to that?
Yeah, I've usually seen and pushed for 2 to 3 months, but certainly, again, always going back to leverage. There are times where you go to zero and realize there's a cash infusion you're doing at closing as a buyer. It really depends on kind of what what you negotiate in the terms, but you always want to start with something that gives the buyer some comfort that they're not immediately pumping cash into the company on top of paying the purchase price out.
Great point. And I think working capital adjustments are a way to swing the value in one way or another in a transaction, and a good financial advisor and a good lawyer can really help you with that. And one thing I always do on the sell side is make sure that deferred revenue is excluded from the calculation of liabilities in the working capital calculation, as there's so many enterprise SaaS software companies that are collecting 3 years or 1 year of cash up front, and they can't recognize the revenue under GAAP. And so that cash then goes onto the balance sheet as deferred revenue, as a liability, and it ticks off over time, and that can really kill you on a post-closing purchase price adjustment. Vitaly, do you want to hit us to the next question?
Yeah, I mean, there's also a question that's somewhat related in investment transactions, right? Kind of price protection and all of that, as opposed to purchasing the entire company, clawback and provisions and things like that. Yeah, I mean, when it's an M&A transaction, it's kind of complete and total, and it's a one-time deal. With investments, a minority investment, somebody coming into a company, it's a beginning of relationship. And everybody basically gets on the same side after that negotiation is done. So they are quite different in strategy and approach you would take. So I'll kind of leave it general at that. But I think that's something that you need to kind of dig into specifics with your advisors when you get in there.
Yeah, I think it's one thing I would add to that on thinking about it from an earnout. You can equate an earnout to a threshold, a performance threshold on an investment where you're talking about further tranches of the investment. So a lot of investments are set up so that, don't use the word earnout, but the company has to hit X in sales. And that'll be the tranche 2. And X times 3 is tranche 3. So you'll see a lot of investments are set up for staggered investments over time, again, based on company performance of hitting certain thresholds.
Yeah, and my advice, if we are going to double click on this, my advice is in that situation where the investor, and you don't have a choice, but the investor, you really want them, they don't want to give you all the money up front, still fight for it and put in maybe a ratchet instead of accepting the tranche, because for some reason, COVID-20 might happen and they might not have the cash to give you and they won't be able to perform, and then you're really screwed. But if you do a ratchet, that means that if you promise X performance and you fall short by 20%, then the effective stock price gets adjusted and they get more equity for the same amount of money that they've already invested. So I've kind of reverted back to that in several deals over the past few years, where the team is confident that they'll hit the numbers, or confident enough. It's better to have money in the bank and do a ratchet adjustment potentially in the future if you don't hit your numbers. And this is for like Series B, C type of deals where the company is, already focused on generating revenue or profitability in some cases, versus, taking this tranche approach, because more often than not, something comes up and you have to do backflips to convince them again to follow through on that next tranche of the deal.
Given that question, Vitaly, and that it's 15 minutes after the top of the hour, I think we should wrap. I'm happy to announce our next webinar is going to be Tuesday, August the 4th, on the topic of venture financing term sheets, where we can talk about exactly the great point that Vitaly in this question is triggering about ratchets and other tricks and of the trade to preserve value and incentivize folks on the upside. I want to thank Natasha Allen of Allen & Hatcher, who had to drop off, my good friends Brian McAllister of MBL Counsel and Vitaly Galam from GS Capital, just superb professionals who I'm honored to be able to work with every day, and invite folks to follow up with questions to any of us on the panel. And we will be sharing a playback of this video on YouTube in the following days, as well as a copy of the slides, which is a good cheat sheet for what should be in a term sheet. Thanks so much, everybody, for joining, and look forward to seeing you on Tuesday, August the 4th.
Thanks, everyone.